Okay, ladies and gentlemen, good morning. Thank you for coming. And let's get started. We'll start about funds and securitization. And today I'll explain about funds in 3 steps. Oh, by the way, there were some slides about Modigliani Miller theorem at the end of the previous slides, but we'll skip that, and if we have time later, we'll come back to that, okay? Right, so I'll explain about funds in 3 steps. First, I'll explain portfolios, and then indices, and then funds. By now, we all know what a portfolio is. Portfolio is a collection of more than one kind of asset. And the purpose is to diversify your investment. There are a couple of different types of portfolios for today. Fixed rate portfolios, price weighted portfolios, and market value weighted portfolios. Fixed rate portfolio has portfolio weights that are fixed. So let's say there are 3 companies, shares available in the market, and you want to construct a portfolio of these 3 companies' shares, and you choose some portfolio weights like 3 to 2 to 1, and you stick to it. So that's a fixed rate portfolio. The simplest example is an equally weighted portfolio, for which your portfolio weights should be 1/3, 1/3, and 1/3. So the same amount of money, equal amount of money is invested in each of the companies. So that's equally weighted portfolio. Price weighted portfolios have portfolio weights that are proportionate to the prices, the share prices. So let's say today, the unit price of Dutch Shell share is £300. The unit price of Barclays share is £200, and that's £100 for Marks and Spencer. Okay? Suppose the share price is £300, £200, and £100. With a price-weighted portfolio, your portfolio weights should be proportionate to these prices. So your portfolio weights should be 3 to 2 to 1. So half of your money is invested in Dutch Shell, 1/3 in Barclays, and 1/6 in Marks and Spencer. But of course, the prices change every day. If the price, after 3 months, if the price is £500, £100, and £100, your portfolio weights should be 5 to 1 to 1. You don't stick to fixed weights. Now, the easiest way to achieve a price-weighted portfolio is to buy 1 unit of each share. So you buy 1 unit of Dutch share, that's £300. 1 unit of Barclays share, that's £200, and 1 unit of Marks and Spencer, that's £100. If you buy 1 unit of each company, 1 share of each company, then your portfolio weights are proportionate to their prices. So far, so good? Now, the market value-weighted portfolios are portfolios whose portfolio weights are proportionate to their market capitalizations. The market capitalization of a company is the total value of all the shares outstanding for that company. So the market cap is nothing but the product of the unit price of a share, the price of 1 share, and the number of shares the company has issued. Okay? The price of a share times the number of shares. So that's the total value of all the shares outstanding. And suppose that's 135 billion pounds for Dutch Shell, and 37 billion pounds for Barclays, and 5.9 billion pounds for Marks and Spencer today. So Dutch Shell is much larger company than Marks and Spencer. So the total of these 3 companies' market capitalization is 177.9 billion pounds. Which means that Dutch Shell accounts for 75.9%, Barclays accounts for 20.8%, and Marks and Spencer accounts for 3.3%. For the market value weighted portfolio or market cap weighted portfolio, these are your portfolio weights. Okay, so the 75.9% of your money is invested in Dutch share, 3.3% of your money is invested in Marks and Spencer. So you put more weights on larger companies. Is the difference okay? Now the price weighted portfolio and the market value weighted portfolio are somehow similar, because imagine a hypothetical world in which all companies issue just one share. Of course, in reality, companies issue tens of thousands of shares, but imagine there is only one shareholder for each company and each company issues just one big share, so that the number of shares is just one for all companies. Imagine such a hypothetical world. If the number of shares is one for all companies, then the price of that big share is the market capitalization of that company. So the market capitalizations and the prices are the same, so the market value weighted portfolio should be the same as the price weighted portfolio in such a world. Okay? In general, if all companies issue the same number of shares, these two portfolios are the same. Now, these different types of portfolios is important because different types of portfolios imply different investment strategies. So think about a fixed weight portfolio. Think about equally weighted portfolio. Fixed weight portfolios need portfolio rebalancing. Every once in a while, you have to rebalance your portfolio. Think about an equally weighted portfolio. You start with 1/3, 1/3, 1/3, investing the same amount of money in each of the three companies. But suppose 3 months passed and the price of Dutch shell has increased while the price of Barclays has decreased. Then your portfolio weights are no longer 1/3, 1/3, 1/3. More than 1/3 of your money is in Dutch shell and less than 1/3 of your money in Barclays. So if you want to recover, if you want to stick to equal weights, you have to sell some of your Dutch shell shares, get some cash, and you should buy more Barclays share using that cash to recover equal weights. In general, if you want to stick to fixed weights, every once in a while you have to sell some of the shares of the companies whose prices have recently gone up, and you have to get some cash by doing that, and you have to buy shares of the companies whose prices have recently gone down. So it's like contrarian investing. You're selling companies whose returns were recently high, and you're buying companies whose returns are recently low. It is as if you are believing that the share price of the companies whose returns were recently high in the past are likely to have low returns in the future, and companies whose returns, I get confused. So companies whose returns were recently low are likely to have high returns in the future. Does that make sense? That's a contrarian investing. In contrast, price-weighted portfolios and market value-weighted portfolios don't need any portfolio rebalancing. Okay, so the prices today are £300, £200, £100. So with a price-weighted portfolio, your portfolio weight should be 3 to 2 to 1. Okay, you can achieve that by buying 1 unit of each share. Your portfolio weights should be 3 to 2 to 1 by doing that. Now, 3 months later, the Dutch share price went up, Barclays went down, so now the prices are 500 pounds, 100 pounds, and 100 pounds. Your portfolio weight should be 5 to 1 to 1 if you want to have price-weighted portfolio, but no problem, your portfolio weights are already 5 to 1 to 1. Yeah? For these portfolios, if the price of Dutch shell goes up and up and up, your portfolio weight for Dutch shell also goes up and up and up. So you put more and more weights on companies whose prices have, been increasing. It is a kind of momentum investing, isn't it? It is as if you're believing that companies whose returns were high in the past are likely to have high returns in the future as well, and the companies whose returns were low in the past are likely to have low returns in the future as well. Okay? This is how portfolio types and investment strategies are related. Does that make sense? Of course, in reality, you don't know if companies who did well in the past will also do well in the future as well. We are not talking about profits. Okay? We are talking about returns. Okay, Apple makes a lot of profits. Apple made lots of profits in the past. It's very likely that Apple will continue to make a lot of profits in the future, but we are not talking about profits here. We are talking about returns, stock returns. And remember the definition of stock returns. Future price and future dividend matters, but there is current price in the denominator. If people expect that Apple will prosper in the future, the current price is already high, So the expected return, the future return may not be very high. It's not so obvious. Okay? Similarly, some company has some scandal and the price dropped a lot. It's also possible that this company has other scandals as well. But, then the current price is already low, so the return may be high. So it's not so obvious if you want to take contrarian investing or momentum investing. Does that make sense? Yeah? Okay, once you understand these different types of portfolios, understanding a stock index, understanding stock indices is an easy matter. Because a stock index is just the price of a particular portfolio. FTSE 100 is just the price of a portfolio composed of 100 major UK companies, and the S&P 500 is just the price of a particular portfolio composed of these 500 major US companies. Most of the stock indices are market value weighted portfolios, including FTSE 100, FTSE 250, together they are called FTSE 350, S&P 500, NASDAQ, and so on. Some of the indices are price-weighted portfolios, such as Dow Jones Industrial Average and Nikkei 225. There are also stock indices which are equally weighted portfolios, such as Barron's 400 Index, S&P 500 Equal Weight Index, FTSE 100 Equal Weight Index, and so on. Now, every day if you watch these TV news programs of BBC or CNN, they report today's value of FTSE 100, S&P 500. And suppose they say let's say S&P 500 index has been increasing for the last 2 months, and you feel like you want to getting on that upward trend of the stock market. Can you buy S&P 500? The answer is yes, you can buy the S&P 500 index because it's just a value of a particular portfolio. So if you make a portfolio of these 500 companies, if you buy these 500 company stocks little by little, that will give you S&P 500 index, in the sense that the value of your portfolio will be very close to the S&P 500 index reported in the CNN. But you might say, well, yeah, if I'm a millionaire, I can buy 500 different stocks, but I've got only 500 pounds for the investment purpose. I cannot buy 500 different companies. But no problem. In that case, you can buy an index fund for S&P 500. You know, if you want to eat fruits, you can go to Tesco and you can buy strawberries and apples and bananas and grapes. You can buy individual fruits. But you can also buy this nice fruits cup for £2, which has like 5 different fruits. The same idea. An index fund gives you a fruit cup that has hundreds of companies in it. Some of them are even exchange-traded funds. So trading them is as easy as buying and selling IBM or Apple or Microsoft. And if you buy an index fund of FTSE 100, for example, then the value of the fund is very close to, will move very closely to the actual FTSE 100 index reported in BBC. Okay? Maybe not exactly the same, but they are very close. Once you see if you see a new index, you ask 3 questions and you understand that index. First question, okay, what companies are there? What kind of portfolio is it? What companies are in that index? That is the constituents of the portfolio. And the second question is, what are the portfolio weights? Market value weighted or equal weights? And the third question, if it is an equally weighted portfolio, then how frequently the portfolio rebalancing is done. Remember, to keep equal weights, you have to do portfolio rebalancing every once in a while. You don't want to do that too often because buying and selling shares needs some transaction cost. But you want to do that once in a while because otherwise the weights will deviate from equal weights significantly. Indices can be constructed for different countries and different industries. There can be German stock index or Chinese stock index or stock index for US technology companies or IT companies. Indices are not just for stocks or shares. They can be constructed for other securities such as bonds, commodities, and currencies. There are many bond indices. There are also currency indices. I don't know, there can be currency index for Latin American currencies or Southeast Asian currencies. There are also indices for asset-backed securities such as ABX. And there are some indices for credit default swaps for CDX, such as CDX. You can even tailor your index. You can make something like, I don't know, my favorite fast food companies index or my favorite video games companies index. I'm sure there are some websites or smartphone applications that allow you to do that. All you have to do is to select companies that you want to include in that portfolio, and choose the weights, either market weights or market cap weights or equal weights. And if it is in equal weights, then how frequently you want to rebalance the portfolio. Now, indices are useful for 2 major reasons. First, once an index is constructed, by looking at that index, you can have a very quick and good idea of how that asset class is performing. By looking at an index, you can understand how German companies are doing, how US technology companies are doing, how Latin American government bonds are doing, or how Southeast Asian currencies are doing. Okay, that's useful. Secondly, once an index is officially published by some trustable institution, people can write derivative contracts based on that index, such as forward contracts and option contracts. To refresh your memory, this is an example of a forward contract. So Tom and Bob agree upon this contract in December 2015, and the contract is on FTSE 100 with forward price £6,500, which says, okay, if FTSE 100 in November 2016 is X, Tom gets X minus £6,500 and Bob gets £6,500 minus X. So if FTSE 100 in November 2016 is above £6,500, Bob pays to Tom, otherwise Tom pays to Bob. And this way, if these people believe that UK companies are likely to prosper in the near future or struggle in the near future, they can bet on that, or they can bet against that without actually buying or selling these companies' shares. Remember, for forward contracts, they don't need any cash at the moment. So they can have more leverage. Okay, for these 100 companies' shares, you can easily buy or sell, but for other assets such as these government bonds or asset-backed securities or credit default swaps, you cannot always easily buy such securities, but no problem if there is index for that, investors can actually bet on or against that without actually trading those securities. So that's another benefit of these indices. Any questions so far? So this is not mathematically very difficult, challenging, but yeah, you need some practice to get used to the concepts. I have 3 questions here, so please try them before the last tutorial session. Okay, now funds. We already saw this term index fund in the last slide, but what are funds? And this is how funds work. Suppose you're an investor and you have £1,000 for investment purpose, but £1,000 is not really large enough to diversify your portfolio. Imagine such a situation. Suppose there are 1,000 such investors, each having only £1,000. What they can do is to establish a fund, and this fund collects money from these investors. The total money is £1,000 times 1,000 people, so the total amount of money is £1 million, and £1 million is not too small to achieve some diversification. So using £1 million, the fund can acquire a variety of assets, shares of companies X, Y, Z, and bonds of government A, government B, or company C. If you are one of these 1,000 investors, basically you are owning 1,000th of this portfolio. Okay? You own 0.1% of this portfolio, which allows you to diversify your portfolio with just £1,000. So buying a fund resembles buying shares of a company that holds various of assets. Because by buying this fund, you own these assets indirectly. Okay, does that make sense? Now, a fund is not exactly a company because these fund-selling companies offer hundreds of different funds to customers, but nonetheless, buying a fund is similar to buying a some shares of a company who has these assets. Now, sometimes, by the way, I sometimes say buy IBM, by which I mean buy some shares of IBM. Sometimes I say buy a fund or sell a fund, by which I mean buy some shares of the fund. Okay? They are the same. Now, depending on what kind of assets these funds invest in, there are equity funds, bond funds, money market funds, and so on. So these are top mutual fund sellers in the United States as of 2011. There are Vanguard, Fidelity, BlackRock, these companies. There are a couple of important distinctions, such as active funds versus passive funds. So active funds are funds for which there are some active fund managers, and these people make active investment decision, what companies to buy, what assets to sell. Okay, that's active funds. Passive funds, for passive funds, they set up one index, like 5100 or S&P 500, and they try to keep their portfolio as close to that index as possible. So the buying and selling securities for a passive fund is more automated algorithm than active decisions by fund managers. Obviously, active funds, for investors, active funds are more expensive than passive funds because you have to reward these fund managers. Okay, you have to pay salary for them. So after such salaries are deducted, your fund return may not be very high compared with passive funds. So indeed, it is a very well-known fact in finance that not many active funds surpass or outperform simple passive funds for a very long period of time. Like, it is very hard for fund managers to continually beat a simple index like FTSE 100 or S&P 500 for a long period of time. And that's partly why, if you ask these professors in finance or economics, okay, what companies should I buy? And they often, the answer you get is, well, why don't you buy an index fund for S&P 500 or FTSE 100? Okay, the distinction between open-end funds and closed-end funds is also important. So for closed-end funds, once the money is collected from investors and the fund acquires these assets, after that, even if you want to buy more shares, you cannot go to the fund and try to buy more shares from the fund. Even if you want to quit your investment, you cannot go to the fund and demand your money back. You have to sell your fund shares to some other investors. It's like the shares of IBM. If you have shares of IBM, if you want to quit the investment, you cannot go to IBM and demand your money back. You have to sell your IBM shares to other investors. Same thing can be said about closed-end funds. You have to sell your shares to other investors. For open-end funds, the fund reports, announces the current price of the share of one share of the fund every day. So the price is called net asset value. So the fund announces the current price of your share every day. And at that price, if you want to buy more shares, you can go to the fund and buy more shares. If you want to sell some of your shares, you can do that at that price. Okay? And behind that, the fund will acquire more assets or sell some of the assets. That's open-end funds. Is the difference between closed-end and open-end clear? So it's for open-end funds, it's more like depositing and withdrawing your money. Okay? Okay, so that's all about funds. Let's look at some website of these fund selling companies. This is Fidelity's website. And we can go to mutual fund. Stock funds, exchange traded funds. Let's go to money market funds. Fidelity government money market funds, okay? Okay, this is the fund information. And this is the past performance of the fund. The net asset value, the current price of your share is exactly $1, $1. And let's look at the composition. Okay, 13% of the fund's money is invested in short-term US government bonds, 3% in US government coupon bonds, and the total of more than 50% of the fund's money is invested in government agency bonds. So government agencies are companies sponsored by the US government. So the bonds issued by these government-sponsored companies are considered much safer than regular companies' bonds. And 27% of their money is invested in repurchase agreements or repos. We'll study what repos. We'll study repos in maybe next week or week 10. So that's their portfolio composition. This is the maturity information. 30% of the investment has very short-term maturity between 1 and 7 days, reflecting the fact that they're investing in a lot in repurchase agreements. Repurchase agreement is like resembles deposit. Okay, so it's very short term. 15% between 1 week and 1 month, and so on. And the average, weighted average of the maturities is 50 days. Okay, its duration of their portfolio is 50 days. Let's also look at BlackRock's website. Okay, their product, active funds. Equity, active, United Kingdom. And they sell like lots of different funds. Okay, this is the fund information. This is the fund performance in the past 10 years. Let's look at the portfolio composition. Okay, 6% in Dutch Shell, 5% in British American Tobacco, 5% in Rio Tinto, 5% in Just Eat, and then Relax, Shire, and so on. And these are UK companies. So consequently, 98% of their investment is concentrated in UK companies. Let's look at the more global portfolio. Okay, let's look at the global equity funds. Okay, this is one global equity fund. So this is the past performance. This is the composition. 3% in Anheuser-Busch InBev, 2% in Alphabet, that's Google, 2% in MasterCard, 1% in McDonald's, 1% in Philips, Apple, Alibaba, Unilever, and so on. And even these stocks together, it's less than 20%. So you can see that by buying this fund, you are diversifying your portfolio. This is the geographic distribution. So 50% in US companies, 8% in UK, 6% in Japan, and then Belgium, Netherlands, and Switzerland. Obviously, with global equity fund, you can diversify country-specific idiosyncratic shocks. Yeah? But, well, to some extent. nowadays the macroeconomy is very global, so it's very unlikely that US economy is in recession and UK economy is in the boom. But nonetheless, with global equity fund, you can geographically diversify your portfolio more than just buying UK equity fund. But of course, UK companies are also doing a lot of activities all over the world. And also, if you buy global fund, you have additional risk of exchange rate. If you're a UK resident, even if US companies achieve 20% return in the next year, if the UK British fund depreciates by 30%, then your fund return is not really high for you. Okay? So that's funds. Any question? Okay, let's move on to securitization. Securitization is the process of issuing asset-backed securities, that is, securities backed by other securities. Examples include pass-throughs, asset-backed bonds, collateralized debt obligations, asset-backed commercial papers, and repos. These played some roles in the last financial crisis, so we'll look into them one by one. And the process of securitization includes some ingredients such as pooling assets, credit enhancement, establishing some subsidiary companies called SPV or SPE or SPC, whatever they are called, and tranching. So we'll look into them one by one. So let's start with a very basic ingredient of securitization, which is pooling of assets. Imagine James borrowing a mortgage. So James signed a contract which says, I, James, will pay £40,000 to the Exeter Bank in a 6-year period. If I default, then the bank can take my house. So his house is used as collateral. Okay. This piece of contract is an obligation for James, but this is an asset for the bank. And for banks, it's okay to invest this type of assets, mortgages. But for regular investors, this is not a very attractive investment. If this piece of contract is sold for £35,000, would you buy it? You pay £35,000 today, and after 6 years, you'll be paid £40,000. That's very high return, but even if James is a very decent person with a decent job, with decent income and decent credit history, for the next 6 years, in the next 6 years, anything can happen to James, and James might partially or fully default. And if that happens, you may have to incur a big cost. So for regular investors, individual mortgage is not very safe, very attractive investment opportunity. However, suppose there are many similar mortgage borrowers with similar characteristics. So here's Paula, who promises to pay £30,000 in 2019, and there is Thomas, who promises to pay £50,000 in 2019. And suppose all these people have similar characteristics, they all have a decent job, decent income, and decent credit history. And suppose they can find 100 or 1,000 such people and pool their mortgages. What they can do is to issue a security based on this pool of mortgages. Let's say an institution named Fannie Mae issues this security which says, okay, the owner of this paper is entitled to 1% of the cash flows from this pool of the mortgages. The Exeter Bank will help to collect mortgage repayment from these people, although the Exeter Bank is not responsible for the people's default. this type of asset is called pass-through. So if you buy this security, whenever there's cash flow from this pool of the mortgages, you will get paid. So it is like you are owning, by buying this security, you are directly owning these mortgages. Okay? It is not maybe the Exe Bank first provided these mortgages to these people, but Exe Bank no longer owns these mortgages. The Exe Bank sold these mortgages to Fannie Mae. But Fannie Mae doesn't own these mortgages either because Fannie Mae sold these mortgages to pass-through investors. If you buy this security, you own these mortgages. Okay? You buy shares of these mortgages. Examples include pass-throughs issued by Fannie Mae or by Freddie Mac. These are the government agencies, government-sponsored companies in the United States whose mission is to acquire these mortgages, bundle them, slice them, and issue these type of mortgage-backed securities. Now, for investors, this is much more attractive investment than the mortgage of just James. Anything can happen to James, but if there are 1,000 people, sure, some of them will default, but others will be fine. We studied that in week 2 when we studied law of large number, binomial distribution. So, okay, now the return is the same as the mortgage of James, but now the risk is reduced. Of course, some investors still might still think that this security is not safe enough, but in that case, the Fannie Mae can offer some credit enhancement, promising to cover some loss up to some amount. Okay, which makes this kind of credit enhancement makes this security lower risk, lower return asset. Now, by doing that, so investors now, with this kind of assets available, investors are now more willing to invest in mortgages. Yeah, no investors want to invest directly in James' mortgage, but this is more attractive. So now more investors want to invest in people's mortgages, which means that these people can borrow mortgages relatively more easily. Okay? The interest rate for the mortgages can be lower, which makes mortgage provision, which can enhance the mortgage provision and home ownership. That's the idea of these companies. Now, in the previous example, Fannie Mae simply collected these mortgages and bundled them and sliced them equally. But they don't have to slice this cash flow equally. After all, investors have different preferences in terms of cash flow timings. So they can say, okay, they can slice the cash flows from the mortgage pool vertically, saying, okay, if you own this security, you are entitled to the cash flows for this asset pool for the first 3 years. Remember this. In reality, these mortgage borrowers have to make monthly payment. So every month there is some cash flow from this mortgage pool. Or they can say, okay, if you have this second type of security, you are entitled to the cash flows from this mortgage pool for the next 3 years. Okay? Not these 3 years, but the next 3 years. And so on. Okay? That way, I mean, investors demand. Some investors have relatively long investment horizon. Other investors have relatively short investment horizons. So this type of securitization can meet a variety of demand. Okay, so pass-throughs are called pass-throughs because for pass-throughs, whenever there is cash flow from this pool of mortgages, the cash flows are simply passed on to the investors of the pass-throughs. In other words, for Fannie Mae, cash inflows from this pool of the mortgages and cash outflows to be paid to the investors are matched. Whenever there is cash flows from the pool of the mortgages, investors are paid. Okay? In this sense, cash flow timings are matched for pass-throughs. But that's not necessarily a very convenient form of investment for some investors. Some investors prefer to have very regular coupon payment, okay? Like semi-annual coupons. So every 6 months, they get fixed amount of cash. To issue such a security, if Fannie Mae wants to issue such a security, then cash flow timings are mismatched. Because there are some cash flows from the pool of the mortgages, but the cash flow payments to the investors are every 6 months. Okay? And in this case, in the second case, cash flow timings are mismatched, and the issuer is in charge of delivering this fixed regular payment to the investors, which means that there is a possibility of the issuer defaulting on this promised payment. Yeah, let's call it a day. Thank you for coming, and I'll see you next week.